Most importantly, I actually think we got 6 years before we have no idea what's about to happen because of the economic singularity. And this 6 years is the 6 years to make all our money. And if we don't, I think we're going to go into a world where we have no understanding of what it's about. On the other hand, the economy is going to be booming, and maybe the stock market's booming, and but in the interim, this 6 years, we can all make money out of this, whether it's crypto, whether it's technology. There's going to be a way to make an extraordinary amount of money out of the biggest technological change in all humanity. So let's just do that.
Renowned macro analyst Raoul, a strong supporter of cryptocurrencies, maintains his optimistic outlook about tech stocks and cryptocurrencies. Pal is convinced that the world of digital assets presents an unusual potential for investors in all sectors. Pal believes that the global monetary system is headed in a different direction than many sound money supporters who are preparing for its impending collapse. According to him, the next stage of the monetary system is already underway as governments become adept at putting things off until an effortless change takes place. Pal's exponential age thesis is based on the speed at which technology is developing, especially in the fields of robots and artificial intelligence. He argues that a radical change is required in response to the world's growing debt issue, which is made worse by an aging population and declining productivity. Pal believes that the combination of robotics and AI will completely rewrite the GDP formula, dramatically increasing productivity and reducing debt. In a recent conversation with David Mattin and Imran Lakha, Pal explores the future of artificial intelligence and artificial general intelligence, AGI, and offers a critical update on the cryptocurrency industry.
If we think that liquidity is the biggest driver of risk assets, and particularly growth assets, crypto and tech are growth assets. If you remember, they led the cycle because they're driven by liquidity and not the business cycle itself, which is what drives stuff like the Russell 2000 or oil companies or gold miners. They're all driven by the business cycle. And we see that right now, the ISM is struggling to turn higher, and then we'll have an upcycle, and those stocks, those cyclical stocks, will do well. But technology way leads that by over a year. Its liquidity in the US at its simplest level is driven by, it's called Fed net liquidity. It's driven by the balance sheet. Is it rising or falling? Well, right now they're doing QT, so they're taking liquidity out of the system, but that's offset with the reverse repo. They've been draining that. That money goes into the market, into the short end of the bond market. That's been adding liquidity, and that more than offset the Fed. Then there's Janet Yellen and her checkbook, the Treasury General account. That's her current account. And we had this liquidity withdrawal from the system based on the fact that there was a reasonably big tax season because the economy grew reasonably well last year. Those taxes come out of money market funds and go into Janet's checking account. So they're now not able to be used because Janet's not spending it yet. So that money comes out of the system. That's a liquidity withdrawal. Okay, so that's what was driving tech down and crypto down. Then what happened yesterday is two important factors. One is Jay Powell said, hey, listen, guys, we're not quite ready to cut rates yet. We're definitely not going to raise them, though, but we're going to do less quantitative tightening, a lot less, from 60 billion down to 25 billion. So that's if you think of quantitative tightening as the Fed putting its head on the beach ball, you take it off, it rises. He's allowing liquidity to come. On the other side, Ellen said, well, what I'm going to do is I'm going to buy back some of these illiquid bonds at the long end of the bond market. Those illiquid bonds, that's just a recycling of liquidity into a less liquid part, but it's adding liquidity into the system. So both of them signaled, we want to add liquidity here. So that was good. The Japanese intervened. They're selling dollars, selling of dollars, intervention of liquidity. So there was a lot of liquidity came back in. And the point being is what we saw with the markets drawing down was liquidity coming out. What happened today and yesterday in crypto, it kind of figured this out immediately, was liquidity is coming back. So that's really the big driver here. As I've said in the everything code work, is all of the central banks have to fund their government's debts, and they all have to work together, and they all have to get interest rates lower, and they all have to put liquidity in, because if not, the numbers don't work. And so that is the game that's actually at play here. Everything else is basically noise.
The international monetary system is in serious trouble and is on the edge of collapsing, as is widely accepted. There is broad agreement among financial experts, economists, and even passionate supporters of sound money, that the growing amount of global debt indicates problems for the fiat system and will eventually make it unsustainable. According to Raoul Pal, the fundamental cause of this worldwide problem is the urgent need for increased productivity, which may be greatly increased by combining robots and artificial intelligence. During a recent Real Vision interview, the CEO expanded on the forthcoming obstacles and highlighted the urgent importance of taking active steps, especially when it comes to investing in cryptocurrency. Let's hear what Raoul has to say.
I've explained to many people that GDP growth is driven by population growth, productivity growth, and debt growth. Debt growth stopped in 2008. It's now just repayments of old debts. Population growth is slowing down or shrinking across the entire Western world, plus Southeast Asia, plus China. So we've got slowing growth, we've got massive debts. That's the big problem we're in. And they've been debasing currency to deal with it. But we have AI, which is infinite human mind knowledge. David writes about this a lot. It's going to be, knowledge is going to be like water. It's going to be free and ubiquitous. The robots, whether it's Optimus, whether it's Figure, whether it's whatever else Amazon is using, are going to be everywhere. A Tesla, after all, is just a robot, car robot, with AI in it. What that means is you have infinite population growth in an economy. Infinite population growth means, what the hell does that mean to GDP growth? And if you lower the cost of electricity that we talked about earlier, you increase productivity growth. So you start to get bananas outcomes with the economy. What happens when AGI comes? The all-seeing, all-knowing AI. What are financial markets at that point? Surely the AGI just wins all financial markets. What job does Imran, myself, David have in that world? We don't. What does it mean for your investments? What does it mean to run a company when everybody can just copy your business using an AI or an AGI instantaneously? When you could say, hey, look at this website, repeat that, it'll do it. Why do we even need humans to make the decisions when you just give the AI the role, hey, you're an AGI, figure out how to make money, right? It's so complicated, and this is coming really fast. By 2030, I think we're coming into a world that nobody understands, and economic models will not work anymore. I don't even know what money is in a world of infinite abundance. Now, I'm not saying 2030 is a doom date. It'll be a process by which we get there, but by 2030, things are going to start feeling really, really weird. And we won't know why the economy is growing so fast, but jobs aren't growing. Why the economy is growing so fast, but something's not happening right with companies. Why do things feel dislocated? This is what is to come. And I think we got 6 years to make as much money as possible so we can just observe it from the beach drinking a cocktail and not try and scrap it out. Your kids are digital. They come from a digital world. They are more adaptable than we all are. We're more under threat than your kids or your kids, Imran, who will just grow up knowing nothing different. So I don't worry about that. It's the swathe of Gen Xers who kind of get lost out in the cracks here, and the older millennials who can't really adapt anymore. That it's not gonna feel good. On the other hand, the economy is going to be booming, and maybe the stock market's booming, and but in the interim, this 6 years, we can all make money out of this, whether it's crypto, whether it's technology. There's going to be a way to make an extraordinary amount of money out of the biggest technological change in all humanity. So let's just do that. We can worry about tomorrow. I'd rather worry about it on the beach than worry about it in some cubicle office at an insurance company in Ohio.
Raoul Pal presents a clear picture of the state of the economy by underlining the three main factors that contribute to GDP growth: population expansion, productivity enhancement, and debt accumulation. He does point out, though, a significant change that has occurred since 2008. The debt growth has stopped, leaving nations struggling to pay off their current loans. To make matters worse, population growth is actually slowing down or even stopping in several important areas. Pal underlines how robotics and artificial intelligence, AI, have the potential to change the world. Productivity might rise dramatically as a result of AI's limitless knowledge base, accessibility, and ability to work with robots such as Tesla's self-driving cars. In his ideal future, artificial intelligence and robots would fuel endless economic expansion and transform traditional thinking. Still, existential concerns are raised by this quick progress. Pal reflects about the potential effects of artificial general intelligence, AGI, on the financial markets, employment opportunities, and even the idea of money itself. Pal advises taking advantage of the next 6 years to profit from this technology revolution despite the uncertainty. In his future, certain generations that were raised in the digital age may be able to adjust to the changing environment with ease, while others may find it difficult. He says that in despite of the uncertainty, one may ride the wave of change and ensure financial prosperity by embracing the technology revolution. Pal urges viewers to focus on creating money in the here and now rather than worrying about the unknowns of the future. Until next time, happy investing.